So good evening everyone and welcome to Tideway's winter webinar, looking backward and forward at the markets. My name is Seymour Banks. I'll be hosting the webinar this evening. Answering the questions, however, and providing the insights, I'm delighted to be joined by James Baxter. All of you I'm sure will know as the founder of Tideway, and also Nick Gate, who's our head of fund manager research. The format for this evening will be fairly simple. We'll start off with a review of 2024. We'll focus specifically or mainly on Tideway's performance during that period. And then we'll look forward to 2025 and obviously looking at both fixed income and equity markets. And we'll be looking to answer all your questions along the way. We have received a number of questions in that respect. Thank you very much indeed. I should say that if you want to ask more questions, please feel free to do so using the tab or the button on your screen, and we'll endeavour to answer as many of them as possible. If we don't get around to answering all of them, we will do so either at the comms at the end of this week or directly to you. So finally, before we start, from a compliance perspective, I need to say that our opinions, any opinions expressed here tonight, are very personal in nature and do not in any way constitute investment advice. So with the introduction out the way, and in line with the format discussed, we'll start with the review of 2024, and in particular, our investment performance. Tideway, James, how have we managed to do for our clients?
Well, thank you,
2024.
Thank you for the introduction. Sorry, everybody on the call, I didn't get the memo about the jackets today, so they were very sneaky on that front. Always done it in jumpers, but we appear to have gone jackets this year.
We're trying to up our game.
Anyway, performance. Well, I think the good news is that we've had some pretty steady performance again in 2024, and that was on the back of a pretty good year in 2023. And then we've also actually kicked off with some quite good returns at the start of 2025. When you put them all together, we've ended up now, getting close to 18–20%, depending on which portfolios you're in. But that's sort of compensated for the 21 and 22 knocked each other out in terms of returns. But of course, we had that big spike in inflation around that time, which meant we were sort of lagging inflation for a little while. But we now have caught inflation up again and are back into real return territories. So all in all, I think it was it's been a pretty positive 12 months for us.
Fantastic.
Nick, you've got some detail on it.
Any specific comments regarding
small bits
equities
of
and fixed income funds?
Yeah, as James noted, headline numbers were very good. Delving into the detail a little bit, just starting with equities, I think one thing to note was that again, returns in equity markets were exceptionally narrow. So again, the mega cap US tech stocks led returns. To provide some context there, the top 10 positions in the global index, the MSCI All Countries World Index, accounted for over 50% of the return. So yeah, a lot of heavy lifting done by just a few stocks.
But the good news was that even outside of those indices, although we didn't obviously, if we'd been 100% in the S&P 500, we would have done better. But even in our more diversified equity funds, returns were pretty good.
Sure, yeah, returns were good. They were in line with the peer group and above long-term equity returns. So yeah, we were very happy with broad returns. But yeah, there were pockets of the market. Nvidia again accounted for close to 20% of total returns, and only 1 in 4 stocks actually outperformed the benchmark. So good returns, but narrow from an overall market perspective. I think that's the message, and that's something we'll come.
And I think you said this morning we smashed it in fixed income.
Fixed income, the picture is clearer. We objectively did well. So our strategy of allocating to high yield credit managers, doing credit selection rather than taking large binary duration calls, paid off quite nicely. So to give some context there, fixed income returns were between 6.5% and 10% gross, which is very nice, and beating benchmarks by between 2% and 5%. So
that was a year that ended up negative for gilts. By the end.
Yeah. So the investment association gilt sector, IA gilt sector, returned negative.
So that's the low risk part of
that's the low risk. So return negative 3.75%. So that's something to know. So very good year in fixed income. We'll come on to the outlook in the following sections. But just to note some slight changes over the year. We as yields increased, we took the opportunity to add some duration and add some credit quality in the form of governments. So again, it was some minor changes, but still sticking with our same philosophy. On alternatives, did not materially impact performance neither positively nor negatively. Our portfolio insurance in a strong year was not needed. Again, we can cover in more detail if necessary.
So fixed income providing positive real returns for the second year running, which obviously is good news. Just to spice things up a little bit, as we look forward to 2025, I thought we'd try and get your opinions as to what might be happening. And the first poll, which we'd like to put out there to you, is on the equity front. And which equity index of the three that we're going to give to you do you think will perform the best? So the three equity indices that we have, first of all, the S&P 500, the classic S&P 500, which is weighted by market capitalization. Secondly, the S&P equally weighted index, so every stock has an equal weighting. And finally, the FTSE 100, and that's the top 100 companies within the FTSE All Share, and much maligned, I have to say, probably over the last few years. I don't know when the last time it did well, Nick.
Just to give some context, so the regular S&P versus the S&P equal weighted last year, I think the return was almost double. We'll get the exact numbers afterwards, but again, it just shows the narrowness of returns last year.
A couple of brave people putting the FTSE 100 as the top.
I think the explanation of the equal weighted suddenly changed the vote.
Yeah.
Very good.
Yeah, just to be clear, if it's equal weighted, it puts 1/500th into each stock, whereas the traditional S&P 500 allocates on market weighting.
So the S&P
7% goes into Nvidia and
so the top four companies in the S&P 500.
0.04% of nothing goes into the bottom 500. Yeah.
So 25% in the S&P is in four companies: Nvidia, Microsoft,
and
Apple,
the results
Amazon.
appear to be in, Seymour.
Yeah, thank you very much for that. And it's a continued support as far as the S&P 500 goes, which is a reflection that the large cap will continue to do well. Perhaps not surprisingly, the FTSE 100 laggard and for several years now continues to bring up the rear. But thanks for that. And with that out the way, we can kick off with our questions. As I said, we'll be looking at the outlook regarding using the questions that we've received. The first one we got, James, is on tariffs and the impact of Trump and possible trade wars on markets. It's obviously dominated the news over the weekend and even today.
Yes, so I mean, the good thing is that these events, when we do them, are not pre-prepared. So we do literally try and bring you up to date as much as we can before we record. So this was a question raised, I think, last week by one of our clients who perhaps knew something we didn't, but of course it's dominated the news in the last 48 hours. So just a quick explanation of the tariffs, just so we know what we're talking about. It's broadly like extra VAT that governments charge on goods coming into the country, so on imports. And it's charged not, as Trump made out in his pre-election campaign, to the country that's doing the exporting. It's actually charged to the US consumer, ultimately. It was charged to the companies in the US that do the importing before. Nick's nodding at me. So it's a tariff that gets raised by a company handling imports into the US, and then it's up to them to decide whether they pass those price increases on to the consumer. And they're typically, if you look, there's lots of tariffs in place at all times. And they're typically 3% here, 2% there. And suddenly this weekend, Trump's come in with these huge tariffs, 25% slapped to Mexico, 25% to Canada, 10% to China. And my God, they've been so bad. It's been an atrocity in Europe. We've no idea what the rate's going to be, but he's building up for a big one for Europe. So why is he going that route? There's basically three broad reasons. The first one is it's a tax receipt for the US government. So the US government's running a huge deficit. It's got this massive level of debt, and so it's in the same position that we're in. Basically, in the UK, Rachel in accounts has chosen to go with national insurance. Trump, with his executive orders and his big fat pen, has chosen to go with tariffs. But basically, it's raising taxes for the US government, number one. Number two, what he's trying to do is make America great again. So this is about trying to make domestic businesses that he won't charge tariffs against more competitive against foreign imports. And so, that's, you can see he's trying to kill two birds. And then the third thing is really, it's kind of his sledgehammer when he goes out as a bully boy trying to do deals. And so bringing everybody bang up to date, the tariffs on Mexico have already backed off for a month, and he's allowing Mexico to have another month's grace on tariffs on the basis that they're going to send some troops and reinforcements to the border and try and stop some of the gun imports and drugs coming north of the border and immigrants. So basically, over the weekend, there's been, or leading up to this point, there's been a huge debate as to how much of it would be around negotiation, how much would it be around true intent to try and raise taxes and make America great again. And so far, and the way the market's reacted today, because obviously we woke up this morning and the futures were down over 3% in the US. And when we've just come on air, it looks much more sanguine and
Pretty flat.
It's pretty flat. So it looks like people are thinking he's leaning more towards the negotiation than a true intent to put these tariffs on indefinitely.
Canada, is it still 25% as a tariff, or is he calmed down a little bit?
He hasn't done anything on Canada yet.
Mexico, is it still 25%?
So Mexico is 25% on hold for a month. Canada is 25% with
but 10%
on oil.
Oh, okay, very good. As you said, bully boy tactics. Another question on the equity front. We're really focusing very much on AI. We in fact received 4 questions, and there's quite a lot of overlap. But I'll ask Nick for you to answer the first question. Will AI continue to drive equity returns in technology stocks this year? It's obviously been a big driver of stocks in 2024 generally.
Yeah, very interesting question, and I suppose the answer to the question may or may not have changed since the beginning of last week, depending on your view. But yeah, it would seem, especially from my personal view, is that the situation since the beginning of the last week and the introduction of China to the AI battle, or bringing them back to the fore, is that the projection for US returns in these big tech companies are certainly a lot murkier. A lot of the assumptions which were originally made, obviously the moats of these companies and large amounts of capital and infrastructure needed, plus the high-end chips, has been debunked for now with I forget the name.
DeepSeek.
DeepSeek R1 coming in with a product which was comparable in output at an absolute fraction of the cost. So the market shared roughly 1 trillion last Monday with, I don't want to spoil it for Seymour, so obviously we had some of the biggest one-day falls in any stock in history. But I think this alone leads to uncertainty, and at the very least, judging by the returns, it shows that these stocks were perhaps priced to perfection. So this increased uncertainty, the competition, will perhaps combined with their already high valuations and earnings expectations, will perhaps lead them to struggle more than most expect.
Sorry. No, I was just thinking another question linked to it, but do you believe small caps can benefit from AI? And obviously DeepSeek has made the access to AI potentially a lot cheaper. So,
well, let's just talk about AI for a moment and what it is and what it isn't. So, what we're seeing now, if you're Microsoft users, or you'll notice more and more functionality thrust upon us, whether we want it or not, as we use the products. So telling us what we've been doing for the last 24 hours, helping us record videos and conversations and do transcripts and transcribes, and prompting us to perhaps improve our presentational material. all this stuff is coming through. But what it appears to me is that this is clever computing taken to a next level, but we don't think it's kind of autonomous intelligence yet. And as we walk through Waterloo Station, there's a nice interesting thing. There's a little cleaning device that's supposed to come out and clean the floor around the bit that we walk through, and it gets stuck in the corner and it can't come out because there's people walking in front of it all the time. So we can see we can see some of the things that AI is bringing to us, but we can see immediately by this, every day we come past this cleaning device and it's still stuck in the corner, that AI is quite limited in its ability to do things really intelligently. So I think the issue isn't, we know AI is here and we know it's coming, and we can start to see now how it's coming. It's coming in extra functionality in all the products that we're used to dealing with. I don't think what we've seen is a huge revolution that's going to suddenly allow us to sack half the workforce or anything like that.
But you're not sacking anybody yet, I hope, James. But nevertheless, what you just commented on is quite interesting, because we've already benefited.
Yeah.
And we're a very small company.
Yeah, and I can see, we can definitely see that we're going to get efficiencies out of the software that we're used to using, with it being more AI enabled. The question mark will be whether that allows us to, significantly increase our profits as a smaller company. It should make us a bit more efficient. And on the other side, will it allow Microsoft to double or treble its fees from us over the next 5 years, which it would need to do in order to kind of sustain the growth path that it's been on? And actually, I think we got a notification to say that Outlook 10 Windows 10 is about to be removed as a product that they're supporting. You have to be on Windows 11 now, and no doubt we're being charged more for Windows 11. So yes, Microsoft is getting some additional revenue through. Is it revolutionary increases in revenue? Probably not at this point in time.
I mean, one of the indications or impacts in the past, the equity returns, we talked about the dominance of the large caps, and there's a question here regarding active versus passive.
Well, yeah,
Sorry.
so I think this is a good point to sort of bring together our outlook on equities, which is to say that we can still see the US dominant, and what's quite interesting by the poll that we just had is that momentum is still very much in the US favour. So the poll of our audience here suggests that most people still think that the US is going to be the dominant leading market next year. But we've just seen some signs in the last few weeks and months that maybe, the dominance of US big tech, it's got some chinks in the armour, just a few cracks appearing around AI, and then, some chinks appearing in the US economy around tariffs and the deficit.
And from a value perspective, obviously,
Yeah, so
as a result, they're extremely well valued, shall we say.
That's right. So I think we try and avoid short-term calls on the market when we're not really keen on trying to predict where the S&P is going to be next year. We're broadly positive in equities for the long term, and we're going to maintain our stance. I think it's fair to say, Nick, which is to have our foot in. We're going to continue to own the S&P 500 as an index, but we're not going to have all our equity exposure in the index, which brings you on to the next one about the
nicely onto how we get access to that equity exposure.
Yeah.
And the comment here is that in equities, at least, 80% of active managers actually underperform the market. We defined it here as S&P 500 per se. Nick, would you like to comment on that? And do you think that's going to continue? And obviously 80% means that 20% are outperforming. So that's the role that you have.
I'm not sure if that...
to try and find that 20%, right?
I'm not sure if that's the stat. That was certainly the stat quoted in the question, so it might be slightly different. I think at the moment it's more like it's closer to 90%. But again, that is a function of the top stocks being the top performers. So
just to be clear, what we've had a period of what we physicists call positive feedback. So not only have tech stocks been doing quite well, and so their earnings have been going up, but also there's been a mad dash into passive funds and more firms capitulating and effectively giving up on active management, buying the index. And every time that happens, because of the way the indices are constructed with this market weighting approach, more and more money pours into the top stocks, so the top stocks just get getting
not only does more money pour into the top stocks, obviously the selling from the sales of the active manager also
impacts the active manager's position.
So there is
really is.
There is definite feedback there, and we'll actually cover this in more detail, but in the next few weeks in an article. But yeah, just a few highlights on the passive world index at the moment, just to highlight some of the risks which we potentially see. So yeah, a few stats here. So the benchmark is as concentrated as it has been since the dot-com crisis. Obviously not too favourable results after that. The US market, which is depending on the benchmark, between 68 and 75% of the world market, is within 5% on most valuation metrics. So you've got concentration, you've got high valuation, and the third part is you already have baked in high earnings expectations for these companies. So whereas over the last few years, earnings revisions have been revised upwards, the hurdle is that much higher. So if you want returns from US equities, you're battling against earnings, you're battling against valuations, and you're battling against concentration. For us, that just suggests that some caution is needed and a more diversified solution. So,
and then you get the risk aspect of it, which is that record drop in Nvidia's price can only happen because it's been driven up so huge, and it's one of the top 3 companies in the world. So the fact that it could drop, I think it was at 600 billion and
580 billion or something
in one session, which was twice the biggest drop ever before. That was in Meta in 2022. So in the course of 3 years, we've got a company capable of shedding 600 billion in value, and it moved the indices about, I mean, not that stock alone, but the indices that day were down about 3%, I think, weren't they? So with that concentration, with those companies getting bigger and bigger, the risk of one of those companies, or the impact of one of those companies having a re-rating of its value, gets bigger and bigger to the index holders.
Yeah, and it's not to say, obviously, within equities, we still hold our biggest position from an asset allocation point of view is the US.
Yeah.
It's much more diversified, and we expect if you like, a broader breadth of market returns.
So if we're if the market, as per the poll, if the S&P 500 does be the dominant market again in 2025, we will probably, like we did with 2024, our equity performance will be lower than the S&P 500. But if the S&P 500 levels off, then perhaps there's a good chance that we might make more money in the other sectors of the market through our active selections. If the market falls, then possibly we won't fall as much as the S&P 500 because some of our positions are a bit more defensive. We've got lower valuations.
Just to summarise, like the portfolio positioning, as you said, less US weighting. We're about 15% underweight. In the benchmark, due to the market cap weighting, that number is increasing every year. So we're at about 53%. The second key difference is our allocation to those top US tech stocks, as we've talked about at length already. We're about 15% underweight there. And the third major difference is the valuation aspect, as James just alluded to. We're around 15% cheaper than the benchmark, but we have actually better forward-looking earnings growth. So more diversified, but still good prospects.
So we think it's worth going passive to get away from those big concentrations. We think there's better defensive natures in the portfolios, and we think there's better return opportunity as well. Now, we may just get washed away by sentiment and momentum, but if we do, it'll be on, and it's on the upside, we'll still make reasonable returns, I think, as a summary. Were there any more questions, Seymour, on equities there before we move on?
I think not coming in as yet. In fact, more on fixed income.
Right.
And the idea now is to switch our attention to fixed income. Before we do so, though, another poll for you, if you don't mind. Very simple one, even simpler than the first. I'll just wait a second while it's coming up. The question is whether 10-year gilt yields will be higher or lower than they are currently today. And if you want to comment on that, Nick, in terms of obviously action on the base rates coming on this week.
So the 10-year yield from memory the range over the last year has been under 4 and as high as 4.85. So obviously adjusting to previous interest rate expectations plus a little term premium there coming in.
And we're expecting base rates to come down next week.
Yeah, so this Thursday I believe there is.
But that's the base rate as opposed to this rate which we're asking you about, which is the 10-year bond yield. So this is more about what's the expectation of inflation and interest rates going into the future rather than as of today.
So base rates might come down, but actually with a steeper yield curve, we might see a 10-year rate higher. So we've got very equal.
My comments there are
view at the
immediately
moment.
shifting opinions.
Yes. Polluting the results.
I am, yeah. So we had before I started speaking, we had interest rates lower, and now we've got a much more even position on the poll, which I think is where we sit, interestingly. So I think it's fairly clear that base rates in the UK are probably too high and are going to come down. We're at 4.75 now. My prediction, Nick didn't want me to make a prediction, but my prediction is we'll come down to around 4, maybe the high 3s, 3.754 by the end of next year. But I don't see this 10-year rate moving very much at all, which is, I think that the 10-year rate probably, if anything, is likely to be flat. It could go a bit higher if gilts are not popular and we start seeing some of the auctions of gilts as there's more money to be, some of the gilts are rolling off and having to be reissued. Do the rest of the world start to not want to buy UK government bonds? There isn't much sign of that at the moment. So I think, I'd probably go for a level prediction on there. I don't know what you think, Nick.
Yeah, that's pretty much in line with the changes we've made. What we have done, although we can't accurately predict what's going to happen next, we have taken the opportunity to dip our toe in the water and add some government bonds, add some duration on yield weakness. So as the yields go higher and the prices go lower, we're taking the opportunity to lock in real returns. Those could go higher, but on the balance of the rest of the portfolio, we think those are smart moves. And
but we're still, I think it's fair to say that we're still not going to bet the ranch on longer duration bonds because we're getting paid over 4% for the area that we're in at the moment in the 6 to 7 years bracket. Even if we went out to sort of 10 to 15 years, we'd only make an extra 0.5% but the risk we'd take on would be huge. Because if those longer term rates go up, then you get a big switch. You get a disproportionate drop in capital values to get those high yields in the long term bonds. So there will be a time for us to be longer duration, but we still, we certainly can see today or in the last 48 hours, there's a lot going on with Trump and the US, inflation risks that might materialize. Deficits are coming into people's minds again. Can we continue to run these deficits? Are we nearing debt ceilings? All these sort of things. We feel there's still too much risk out there to be starting to bet 10 years and longer. So we're going to keep at the shorter end.
Yeah, just to add to that, James. So our duration, our fixed income portfolios, they do vary slightly depending on the portfolio, but broadly speaking,
what are we averaging at the moment?
Around about 4 years. So
4 years.
Yeah. So we have that. The mixture of short duration strategies and longer duration strategies. At the shorter end, you have reinvestment risk from cash. If rates go down a lot, then you're not being able to reinvest at good rates. So you're balancing that with, as you pointed out, the volatility at the longer end. So you can then go to the longer end and lock in these real returns for, as it sounds like, much longer time frames. However, you do where the mark to market, as it's called, the volatility in between. And the longer you go out, the more your capital value will move around in that period. So yeah, we are very much, we're making incremental changes, adding duration very slightly when it suits us. But yeah, pretty much sticking to our credit managers, sticking to the tested solution or tested process of hiring credit managers to avoid the worst credit losses, taking the premium, and not doing any silly duration calls which could hurt us over short periods. So keeping it balanced.
And I think those fixed income returns are, it's a bit like the hare and the tortoise. We were as of Friday, we were up almost 5% in our equities year to date in a month, which obviously is not sustainable because you'd be you'd be doubling your money in very short order at that pace. But we were also up 1 and 1.4% in fixed income. So, and that fixed income is much more baked in now, whereas we've seen today, we may have lost one of those 5% in equities, maybe a little bit less now, but we woke up this morning, we could have handed back half of that gain in equities, whereas the fixed income, it keeps coming in, we know those coupons are coming all the time. We got a dividend distribution on Friday which pumped up the valuations quite nicely for those who were looking at their accounts over the weekend. One of the increases for those who've got distributing fixed income funds is the distributions arrived in the accounts, and that keeps coming in every month, which is great.
Yeah.
Can I just say, that's a pretty comprehensive review, and obviously the questions are regarding the outlook for bonds, including gilts and corporates. We talked a lot about duration. Credit spreads. Nick, do you want to comment on those and generally where they are and how our managers are playing them?
Yeah, so in contrast, I think taking a step back on credit portfolios, you have high all-in yields, and that is obviously a function of two things. Firstly, the government bond yield, which we've discussed, and secondly, the credit spread element. Obviously, part of the reason we've had good returns over the last year is the credit spread element. So we know the government bond yields have gone up, but the credit spread element has compressed slightly. So our thoughts on credit spreads at the moment, they are tighter than they have been compared to history, but not unduly so that you get no reward. More so in the US and the UK, we're mainly situated in GBP bonds on the UK curve. We still feel like we're rewarded well. But the other aspect of the tighter credit spreads is the market is strong, the fundamentals are strong, there aren't that many defaults. If you look compared to history, there's been a much greater proportion of the market in high yield, in like the single Bs. As you get further down the credit rating spectrum, the overall market is better than it has been. And so although optically they may look tight, we still think there's more to play here for us.
The expectation of recessions has slightly gone away. Is that fair to say?
Certainly in the US.
Yes.
So I think the expectation of significant increases in the amount of companies defaulting on their...
Listen, if you get widening credit spreads as a result of recession expectations, equities are going to be hit first.
All over the place.
We feel comfortable with our exposure there.
Yeah. And I think generally we are relatively cautious as a company. We know that we're managing pension fund money for a lot of people. We do have the equity portfolios, and we've been getting an improved performance on those. But the fixed income is where we put a lot of effort into, and delivering those returns means we've got that kind of core engine of growth in the portfolios, which hopefully going forwards means we get more years in the 6, 7, 8, 9% than in the sort of +2, -2 region that we were occasionally getting when interest rates were very low.
Yeah, the last point to make on credit spreads is the fixed income credit market is very inefficient. So if spreads do blow out in the short term for whatever reason, our managers have historically done an excellent job of snapping up.
Back to that question of active versus passive in the equity market. It's much more it's much more of a balanced equation as to which way you might go, and if you know what kind of companies you want, in some ways it's relatively easy to buy an index these days that tracks those kind of companies. But in the fixed income space, the active managers are certainly the ones that we look at, and they've got a really good track record of delivering returns over and above the index, because they can play with this duration, they can decide where they want to go. There's lots of
forced sellers.
There's lots of issues, new bonds being issued, which tend to get issued to go, so they price very attractively when they're launched, and they can take advantage of all of those things.
Plus notwithstanding,
indices are biased in favour of those companies who are more in debt, right?
So the most indebted companies have the highest weightings in fixed income indices. I hope we can...
There's another point on this active versus passive, which is just worth bringing up. So, there's the question of, in the equity markets, there's two things really. There's what you're holding, so what's the underlying investments, do you want those or don't you? But the other big issue with passive is obviously the price you're paying. So historically, if I look back maybe 5 or 10 years ago, we were typically paying close to 1% for active investment management, and the trackers were coming in at 0.2, 0.15. Now we can track for 0.06 or 0.05, but also we're seeing quite a big reduction in the passive price, and as we've published in our market update, we've been constantly seeing reduction in fees
in the active managers.
And what are we? Have we
Nick,
got
you've
an
been
average now
negotiating
on-
quite hard, haven't you?
I don't know about that. I don't know on average actually, but yeah, we have had.
We've got a number of managers where we're getting under or
Yeah.
0.6 or below.
Yes, correct. Yeah, just through scale and obviously.
Nick's being very modest because he has been quite good at helping the managers launch new funds. So if we can see a strategy where we like the strategy, we like the fund manager, and they need some help to get it off the ground, we then get founder share classes and we get to invest in that fund forever at a nicely discounted price. And that's been happening a bit.
Yeah, but equally, a couple of funds we've been in for 6-7 years, they have
just reduced prices.
Yeah, we have.
Very good. I mean, talking about the difference between equities and fixed income, and obviously diversification between those two asset classes, we've got a question here. Goldman Sachs's asset allocation experts have recently said that diversification is the key for investors in 2025. Does the Tideway team agree with that?
Well, it's hugely flattering to be labelled compared with Goldman Sachs, but also one of our clients gets their market updates, and we've been interested to watch just how difficult this whole business of predicting markets has been, and they were wrong on their fixed income predictions within about 3 weeks. And then yesterday they published an update saying, "Oh my God, if tariffs are coming in, we're probably wrong on our equity predictions as well." So they've obviously got a lot of people researching and a lot of mental capacity within the business, but it's extremely difficult particularly when you've got somebody like Trump coming into the presidency to know what's going to do. I mean, we spent quite a lot of time today looking at economists' views of what tariffs might do, and nobody really knows quite how tariffs will impact, because you don't know where the price is going to get passed on and where it's going to bite. We don't know whether he's going to do it or whether he's just negotiating. So we have to look through some of this noise and make some long-term decisions.
Yeah.
But diversification is something we agree with.
I mean, I believe their quote was something along the lines of, go away from the Magnificent Seven. It's too expensive. It's too risky. So essentially, obviously, the first element of the call here, that is what they're saying. So,
yes. So you might think of diversification as sort of equities, bonds, but what we're saying is within equities we can be quite highly diversified by having some index, but also having some active managers who are selecting away from the index. And in bonds, we don't necessarily want to hold the index, but we can also be diversified away from the index in terms of duration and the kind of funds we're in. So we are lovers of diversification. I think it's really
the one
important.
free lunch, isn't it? In the investment world.
Yeah, exactly.
Yeah, so they're
Look, it does mean in years you're never going to be the top performing fund, if that makes sense, because if you're diversified, you'll probably own a bit of the thing that's done the best, but you won't be all in. So yes, if you were all in US equities last year, you could have made 25%, but it's all about avoiding those big downdrafts as well. So we're keen.
Their suggestion, I read that article, was there is an element, if I got it right, their suggestion was in the US anyway to buy an equal weighted or go mid cap, and obviously one of the moves we've made this year is to add a US exposure via mid caps. The Lyle America fund.
We saw one statistic actually was if you put $1,000 into the S&P 500, you got $350 in 7 companies, and 90 cents in the bottom 7 companies. So 350 goes into the top 7, 90 cents goes into the bottom 7. So that gives you some idea of how they're tilted towards those very large companies.
Yep. So diversification, obviously a good thing. We talked about predictions in various ways. The question here is, what's your outrageous prediction for 2025? perhaps I could pass that on to you first, Nick, and then
James-
maybe James
No,
you
no,
can
Nick,
come in
Nick,
after.
James does outrageous better than me, so we'll see what James says first, and then I'll
Oh, right.
No, no,
Can
you
you
can do.
please,
You go first. Nick.
then I'll temper my response accordingly. My bold or outrageous prediction is that the US markets will be a bottom quartile return for developed equity markets in the next year for aforementioned reasons. But as noted, it can take a while, momentum-wise and valuation-wise, for this to play out. So yeah, hence the outrageous tag. So that's what I'll go with.
Well, that won't be difficult to beat, James, in terms of being outrageous.
Well,
Surely.
I had one answer this morning, which unfortunately has been delayed a month. But I had this vision that rather than the US take on Canada as the 51st state, is it? I thought that California, who are basically avocado eaters, would split off with Mexico to come out of the United States of the Union and get rid of the tariffs, and there'd be tequila and avocado going up one way and guns going
That
down
is
the
an
other and drugs
outrageous
the other.
prediction.
So that was but obviously that isn't going to happen because this Mexican Prime Minister looks very sensible and seems to have got the better of Trump already. So I thought my next one after that wasn't going to work would be that Bitcoin would get robbed.
Robbed.
So
Okay.
I did read something about the fact that there could be some sort of security breach of the Bitcoin blockchain, or whatever.
Okay.
And
that's a left
one
field.
morning, all the Bitcoin holders will wake up and they don't own the Bitcoins anymore.
Well, that's interesting. Well, we'll note that. I feel as if I can put in my own outrageous prediction as well. It doesn't constitute investment advice, let's be clear. So mine is that FTSE 100 will outperform the S&P 500. So diametrically opposite to the prediction of everybody, or most people at least, on this call. So thanks very much for that. Did say right at the start that we'd be including some questions regarding financial advice. In fact, we already have received 3 or 4. They all tend to coincide with the issue regarding inheritance tax and the fact that pensions have been brought inside our estate. So James,
We haven't had
certainly
too
one for
many
you.
questions coming in from users, so
One coming in. I can't.
it'd be nice to get some more questions coming in.
So the question is, obviously, we've seen that inheritance tax rule changes. We've seen more clients probably drawing down pensions, and we'll be advising them to draw down pensions in the process. I guess the implication is that our assets under management might fall, James. And does that mean we're going to increase our fees? An outrageous question.
That wasn't a.
So I thought I'd direct that to you straight away.
That is
but
a
then
very good question.
let's turn to think about, what does that mean for us and an alternative?
Well, look, it's a very
assets?
good spot to recognise that obviously we have focused on a particular area in terms of taking on clients. Certainly between 2015 and 2020, we were very focused on DB transfers, and that's given us this, very nice bucket of clients who are basically withdrawing their money, and unfortunately, I'm going to have to encourage them to withdraw more of it and spend more of it, which is a great thing, really. So it does mean that naturally, as a firm, we lose. I think it's running at about 25 million a year is going out of our portfolios. But so far, in the last couple of years, we've managed to take on as many new clients, if not a little bit more, so that actually our overall assets under management is increasing. Perhaps not increasing as much as we'd like, and we're always keen if anybody would like to make a referral to take on new clients. But we have seen our assets under management
we're
break
approaching
through
470
million. We're nearly at 480 million, and we're targeting to get over that 500 million as soon as possible in 2025. So we're not under any pressure at all to put fees up. Let's be clear about that. We are getting fees reduced in the portfolio, so we're seeing the overall expenses that our clients pay shrinking. It's probably shrunk from sort of nearly to 1.85, 1.9. It's coming down and down. It's probably in the 1.6 region now, and let's hope that we can continue to do that and get it closer down towards 1%. If we could get more clients on board, and we're obviously endeavouring to do that now, and we see the assets grow, we might even contemplate fee reductions, not fee increases.
Yeah, I mean, I think that's the general point, is fees have gone down for clients overall.
Yes,
as a result
overall the
of
fees are
reducing the underlying
overall fees are
investment
going
management
down.
fees.
Our fees are pretty static, but we would like, if anything, to push it the other way, not.
And the business remains stable and is actually broadening out in terms of client base. Actually quite nice to see the next generation starting to come on board.
Yes, well,
for
you
existing
mentioned the
clients.
IHT and pensions. Obviously, that's the big news that we're waiting. We're waiting now to see what Rachel in accounts, whether she's got any.
Yeah, there's a question
Clever,
of any updates, but I don't think
we
we've had
haven't-
an update yet.
I checked the website over the weekend. There is yet to be any update on the pensions and IHT. We know that AJ Bell, Hargreaves Lansdown, Interactive Investors, Royal London have all written to Rachel and said what you've proposed is basically unworkable from a practical perspective and is going to take months and months and months to process pensions on death. So we think that there's quite a good chance that there will be some change to the way that the tax on pensions on death is, how it actually practically works. Although I'm doubtful that we're going to see a big U-turn and that we're suddenly going to be back to where we were before, with it being a relatively attractive thing to pass on. So I think that we will be, although we've got until 2028 for the rules, 2027,
April 2027.
for the rules to kick in, I think we will be, as the year goes on, we will be, and we talk to more and more of you, we'll be talking about bigger withdrawals from pensions. I've done some maths. So I've published 2 papers. If you're interested, there's one paper out on annuities. We did have a question about impaired life annuities, which we'll answer directly with you, but generally they're not much better, or in fact they're generally worse value than normal life annuities. And all they are really is an indication of how much more income we can deliver people given the new interest rate environment that we're in. So I've done some maths, and we will be talking to people who want to exhaust their pensions through their lifetime. We're going to be looking at withdrawal rates of somewhere between 6 and 10%, depending on how old you are and whether or not you want a level income or you want it increasing with inflation. So I think we are going to see higher withdrawal rates out of pension funds, and that's going to probably change the way we think about how we invest those pension funds as well. Higher withdrawals are going to make it harder to invest in equities and volatile investments, and keener to invest in fixed income.
And the alternative wrappers there for?
Yeah, well, so the withdrawal, the drawdown, new approach to drawdown is a paper I'm going to publish later this month. We did have a question about wrappers. So just to be clear, that
we don't just use SIPs.
Tideway is very happy to manage your money in SIPs, in ISAs, in general investment accounts, in offshore bonds, in trusts. So we are open for business and open to be able to advise you on all of those different wrappers. So if you've got money outside of your pension and you haven't talked to your wealth advisor about it and would like to, then we're open to do that. Or if you are with somebody who wants to invest money outside of a pension and you're wondering whether you can refer them to us because you know us as pensions, we absolutely can do a broader service than just the pensions.
Very good indeed. We've got a question coming through, kind of reflecting the interest of our clients on fees, and it's a question: AJ Bell putting any pressure regarding the cost base, and have we got a positive relationship with them? I think it's fair to say our relationship goes back a long way, James. And it's improving all the time.
Andy Bell will return. If I email him on a Saturday morning, he generally returns my email by Saturday evening. Not that I do it very often, but if I'm desperate need to speak to him, Andy and I have been doing business with Andy since 1990, so he does know me pretty well. And several people who've worked with me and for me have gone on to run quite big businesses on AJ Bell as well. So we do get reasonably well looked after, I think it's fair to say. We actually renegotiated our contract with AJ Bell. Neither of you probably know this, but we did it last April from memory. And we struck another 4 years with a 2-year break, or 6 years with a 3-year break. I can't remember. So we have an ongoing contract with them. If anything, I think the pressure will be on them will be to reduce fees as well, because there's a few new entrants coming in who are offering to do something similar for us that AJ Bell does, but at a slightly cheaper price. Neil, our CEO, looked at those. We did a sort of a proper review of what was available before we renewed with AJ Bell, just to make sure that they were being honest. But we went with AJ Bell because, in addition to the price, we know that they're going to deliver on the service, and the price differential wasn't that much, and we didn't have quite the confidence in the ongoing services and support that we have with AJ Bell. So they're a great partner for us. We're very pleased to work with them, and we are well connected with the senior management, it's fair to say.
Couple of questions again. I think it's reiterating a little bit what we've discussed before, but do you have any further thoughts on the proposed inclusion of pensions into your estate for inheritance tax, apart from the fact that it's made people have to revise their plans completely?
Well, I think the reason why I'm confident in saying that I don't think we're going to get a U-turn on the tax is that pensions were never really designed for a tax efficient vehicle to pass on to the next generation. It's just where we ended up with as we changed from annuities originally to then drawdown with a death tax, and then we got the removal of the death tax, and we've had a period where we've got kind of used to. And what's interesting, I think, when we talk to the clients is that it has made us all a bit lackadaisical about thinking about our pensions, because, and also thinking about inheritance tax and how we pass money on to the next generation, because it was relatively easy to put the conversation off and think, well, the pension fund's going to be tax efficient to pass on, and they can worry about it after I'm gone. And actually, I think what's been quite good about the legislation change is it's got everybody talking about inheritance tax more freely, and hopefully engaging with their children and having a more proactive conversation. Because I think once you get your head around the fact that you can't take it with you, then it makes a much more interesting later life period to be trying to hand the money over in an orderly fashion rather than ignoring it and then leaving it all until after death. And so I think it's going to be a big topic for us going forward. Yeah.
I mean, and you've always said that inheritance tax is actually a discretionary tax if you are prepared to plan far enough in advance.
And it remains so that we didn't see any changes. We had the budget seminar, but I remember Ben saying, there was no changes to the gifts. There's no changes to the taper relief that you get as you go through the 7 years. We've still got gifts out of income that are immediately outside of the estate for inheritance tax. So there's an awful lot we can help you to do and that applies both upper generation and downer generation. So we're actually finding with clients, we're having conversations about their parents, and I'm just going through it with my parents-in-law. Both my parents are dead, unfortunately, but my parents-in-law are very much alive, and they're just turning into their 90s. And we're doing gifts out of income, and we're doing some larger gifts still, and we're thinking about how we're zoning in on where they might be eventually, to avoid paying too much tax whilst keeping them in the manner to which they're living in the manner to which they're accustomed. So these are conversations, they're not easy to have sometimes between generations, but I would encourage clients to try and engage both upper generation, if you've still got your parents alive, and downer generation, as our young kids, in my case, now are in their 30s. So they're not kids any longer.
And from an educational perspective, the earlier...
I think the earlier you get the conversations going, and the more collaboration and education those are the two key words. I think collaboration within the family and education of the next generation to look after the money in a good way. And, we're very keen to do that. We are taking on youngsters at a relatively rapid rate of not at the moment. So I always used to say we almost had enough for a disco. We've certainly got more than enough for a disco now. But we're taking on quite a few clients in their 20s, late 20s and early 30s.
Which is quite a contrast.
Which is good.
On the education front, one of the things looking back at 2024, which was very pleasing, was that we get approached by the FT, certainly the FT on the weekend, particularly you, I have to say, James, for your advice. We also got invited by Martin Lewis to attend or to present with the only wealth manager to be on is not the Martin Lewis podcast. How do you feel about that, James? Are you going to carry on in that vein, or is it,
Yeah, no, absolutely. I mean, these things come by invite, so I can't say for definite what I'll be doing, but we do have a good relationship with the FT. I think they like our style, or they like to get help from people like me to come up with ideas. So it's it's quite a nice two-way flow. So the FT definitely. We occasionally have been mentioned in the Telegraph and Times, but it's a bit harder. Yeah,
We don't have a PR consultant to help us in that respect, do we?
No, we're doing it ourselves. We have Sarah who helps us, but generally, we that's part of my job is to get that done.
Very good. Nick, any final comments regarding funds that we're invested in? Any particular favourites? I know you like to talk about your favourites in the past.
Which do you think will be the best?
In equities, we've talked about Dundas. In fixed income, do you have any particular favourites? You've been diversifying a little bit, I think, during 2024.
I love them all equally. No, in the fixed income front, the one fund we have been adding relatively consistently is the Man Sterling Corporate Bond Fund. That is, if you want to label favourites, that is an up and coming favourite, shall we say. We now have built a decent position over the year. One element we like about that fund is
how much have we got in that fund?
It is joint largest position fixed income wise.
So that's about 40 million.
Bit less.
35 million.
Yeah, and the manager has historically achieved all his returns via credit selection, and he has been near the top of the leaderboard in each year. Does very detailed analysis, has a very strong team behind him, and he has proved. Obviously, he started to launch his fund at the worst possible time for fixed income funds, just at the beginning of 2022, I think, after a long stint at Schroders, and obviously all fixed income funds performed poorly to begin with, but he recovered very, very strongly, and we think excellent risk manager plus good returns on top of that.
I'm conscious that we're approaching the end of our time. There are a couple of questions which remain outstanding, and we will get back to you directly on that. I can assure you. And if we don't, then just give me a ring directly, and you can certainly cause me a certain amount of grief, because that'll be my fault for not having done that. I would like to end it though by saying, first of all, thank you very much for attending. It's wonderful to have increased number of people attending, but also increased number of questions, so that we can play this webinar as in response to your interests and your concerns. Obviously, like to thank you for continued loyalty. I think, if you look at the last 5 years, unbelievable amount of volatility in the markets, unbelievable volatility geopolitical, but we've had a number of clients, most of our clients come from before 2020, and have all remained with us, so much appreciated. Otherwise, we look forward to your attendance at the next webinar. Thank you very much indeed.